Welcome to Smart Helping, and today I've put together a full-purpose real estate model. Now, a couple of things. First off, disclosures. I'm not a financial advisor or certified to sell investments or anything. All I'm doing is building this Excel template, and you can use it at your own risk and to your own devices. Okay, so let's get into what this actually is able to do. It does two things. One, it can project if you just have a simple real estate investment that you want to track its cash flows annually, net operating income, and free cash flow after tax. It will do that on an monthly and annual basis. You see here, this goes out to goes out 30 years, but you can have a deal as short as 2 years or a sale date of the building. And it will show you your free cash flow after tax. It does add back in depreciation, and it includes the building sale, capital gains, closing fees, and all of that. So this model will show that on a nice, you see your returns here. That's the simplistic part of the model. What I have added and what was so intense to try to get right and be completely automated with everything else was the sponsor and investor breakdown with IRR, or internal rate of return breakdowns. So what I've added is a sheet here, and we'll start kind of going backwards with the model on the output values. So here we've got the sponsor column and the investor column. The sponsor column, let's say based on all the inputs, the sponsor invests $1 million, the investor invests $3.1 million. We'll see the project internal rate of return of 23%. Then you've got your total cash returned before hurdles, pre-tax, 3.6 million and 11 million. And then this money is including your investment. So it's the total cash you're getting back from over the whole course of the investment. So you're putting in $1 million, you're getting back 3.7. That leaves you with a net profit here of 2.6, and for investors 8.5. And the cash on cash return, which is always going to be the same because it's the same money, it's just split differently. So that's the top part. Now where it gets complicated, but I made a really useful thing to make this complication visually simple and editable. So it's based on the sponsor's ability to get a higher project IRR. And if they do, based on these hurdles, they get more of a share of the money, even with less invested, or regardless of what they invest. So what this table does, it simply starts you with the beginning capital equity. So the sponsors got 23.99, which is right here, and the investors got 76. As you go down, based on the IRR of the whole project going up, the sponsor starts to get more of a share, and you can see each hurdle you get more and the investor's getting less, but this always adds up to 100% as it has to. And then you can see the investor's share here, they're losing 15% of what they would get if there was no hurdle, but that's what the investor is giving up in return for the sponsor to do a really good job. And these can be set at whatever you want. These could be 5, 10, 50, or 25. And see, that changed because the 23% was just under this. So now the percentages all change and the cash flows change. Say 35. And then you could change what the promo actually is going to be for the sponsor. So it could be, it could be 10% at hurdle 1, 15% more, and then 25% more. And that'll all change the cash flows between the sponsor and the investor. Okay, and you can see as a check the total net cash flow here, 11.241. That should be the same after the hurdle, because the hurdle is not increasing or decreasing the total cash flow available. It's just changing the split. So you see 11.24. We sum up this. Yep, 11.24,707, the same exact number. So that's a good check. Then you can see there's also going to be an IRR based on the new cash flows for the sponsor and the investor. They'd be the same up here, but now they'd be different because your cash that each one is getting is different relative to how much they invested. So you can see that, and then you can see the cash on cash return as well, which is just simply saying what's your net cash flow pre-tax divided by how much you invested. So for every dollar invested, you're getting $3.85. The investor, for every dollar they invest, they're getting, $2.33. Or, yeah, as you can see, well, no, for every dollar they're investing, they're getting $1.33 back in profit, which would be, as you can see here, the investors put in 3.1 million. They're getting a total back of 10, but their actual profit is 7.3. So it's about double, which 200% would be double. So that makes sense, right? Just over double what they put in. They're getting out as a profit. Okay, so this is cool to show the breakdown of each side and where the hurdles are, and it works. It's great. So the model does go out 30 years, and it will be based on your. Okay, so now let's go over to the assumptions. So the year is going to be based on your start date of the project and your end date. So let's say this is at starting on Jan 1, ending on Jan 1. Let's say if it ends on 2020. Oop. What am I writing in here? 2020. Now it's a 4-year deal. Your internal rate of return updates based on that, and now look at the annual cash flows. Only 4 years. 1, 2, 3, 4. Well, you're holding it for 4 years, but you still got all of 16, 17, 18, 19, and 20. So it's really 5 total years of cash flow. Next up, we have property building cost, a simple input. Then the sponsor capital investment. This is just the amount that you would want to put into the deal as a developer or sponsor. And then you've got your financed amount. Could be whatever percentage you want. You see that all updates this whole thing based on the cash flows. And I've got a depreciation schedule or a amortization schedule that's completely dynamic, that feeds off of your inputs for the financing data here and the financed amount. And then your equity required from investors is just what's left from how much you put in as a developer or how much the developer itself has put in and added to the amount you're financing, and then you need this much more to come to the total of 6.7 million plus these total setup costs. And so these three are 6.948, and you can see if I sum up the top two, we're at 6.948. So that all matches. Now let's come down to, let's do these setup costs. I've added it at the bottom. This is what, you got refresh, closing, loan fees, acquisition fee, repair, maintenance, furnishing. This is supposed to be to help you plan for a holding period, and you can see, or a lead time. So you can see here I've got 4 months. That means in the first 4 months there's no revenue coming in, but you still have costs. So this model has allowed you to plan out, generally speaking, how much you want to have available for those costs, and it puts it into the whole overall deal for the amount of money you need to come up with. And then I've done a metric here at the end that shows here's the total setup reserve, and that's not taking into account closing fees or loan fees or acquisition fees. It's just taking the repair and maintenance reserve, the furnishing, um, the refresh rehab costs, and other costs. And then this next number is simply counting the total negative cash flows in the first year. And then there's your net reserve that you need. Now this could be this does take into account any negative cash flow. So if there was a negative cash flow in the future, and let's say you were just putting in your monthly cash flows of actuals, this would pick that up, and you could see how much is left in the reserve. Or it would also break down on a monthly basis what percentage the sponsor or what percentage the investor is on the hook for if there's a negative amount in a certain month that needs to be covered, if there's no money left in the bank to cover it. Now obviously there should be plenty of money if there's only like 1 or 2 bad months for whatever crazy reason. There should be enough cash flows from the actual investment to cover it, but that will all show up there. It was difficult to get all the numbers to come over into the annual and to come over properly so you can actually check everything, and it does add up to all the monthly flows. But it all does. It took a lot of time to get this straight, but it is straight. I have added back in depreciation into the net cash flows pre-tax to give a closer feel of what money is going to be available and actually moving in. Okay, so that's that part. That's your investments, your equity percentages based on your capital, closing costs, the loan term. The loan term is very dynamic. You can put in like 6 months here, and it will only show up. You see, debt financing will only be every other month since you're doing 2 at a time. The loan balance goes across, so you can calculate when the sale of the building actually happens. It takes into account that sale, the capital gains tax. It's not including any income tax. That's just for this purpose if you're doing this by yourself and wanted to see your own after-tax possible cash projection. It takes into account the debt service for that month as well, adds back into the depreciation, and that's how you get to these numbers down here. So cash flow after debt service before tax, then cash flow before taxes, including the building. So this top line and bottom line are the same. It's just the bottom line includes the building effect, and then that all flows down to investor share and the sponsor share each month. And then I've got that going on a annual basis. And let's just, so you can see more, let's put this out to say 2035. Now you can see it's going out to 2035. Here's your sale date and aggregate and everything. Feel free to go ahead and check these numbers based on what they're supposed to be. Let me get to the top. This is the revenue, vacancy, net rental revenue. So I made the model. I've tried to make the model. I've used everything I've learned in real estate modeling and put it all together. I've never done one exactly like this that has been able to include the IRR hurdles and the splits between sponsor and investor, but I think is really, really nice. Another thing is with the depreciation, I have added in a depreciation schedule that you can go, this 39-year building commercial property is coming from the purchase price, and then you're getting that depreciation, and then the depreciation is pulling off of that schedule based on the year. So that's pretty cool, I thought. This in itself, and this does mid-quarter convention, mid-month, mid-quarter, mid-year, and it also has 200% declining balance, 150%, 7-year. It does a whole bunch of stuff. I mean, it also does basically a net present value of the savings based on the different methods you're using, bonus depreciation as well. It's a really nice sheet for depreciation, but I've just simply used it for the straight line for a building. And I'm pulling off those numbers. The debt, I went over that. Really nice schedule here. Can be used on its own, or you can use it with this model. It's really good. We got our tables. These are all the tables I need to pull the correct data. And then, okay, monthly, annual. Okay, so where were we on here? We have our rent. We have our investment assumptions. We have rent growth, and you could actually change the rent growth 3 different times during the investment. This gives a little bit more flexibility and accuracy when projecting out what you think you're going to make. So you guys, year 1 through 10, 11 through 20, 21 through 30, and you could change the rent growth each time, and that's annual rent growth. Same with the expenses, 3 different times during the investment, and it's annual expense growth rate. Next up was a nice thing. You could change how you want to project what you're going to sell your building for. You could either do a terminal cap rate, which you'd put a Y in that box, and then put whatever the cap rate you think you're going to be able to sell it for. If you don't want that, if you want to use the annual appreciation rate, you put a Y in that box. And you can see it's going to go 3% annual, and that's all changes. You see, let's see, what does this do? So you're at project IRR of 17%. Net cash flow 6.2, 16. Let's change it back. Let's change it back to this. Not too much of a difference there in the values, but it could be, just depends on whatever you put in on these percentages, which are editable. All the blue text is what you can change in this model. Lead time, like I said, that's the amount of time it takes before you're starting to collect revenue. And capital gains, income tax, and then these other costs. So those are all your inputs that you can do to try to get a feel for the cash flows of this investment in this specific property or building or commercial property. I think I've covered almost all the bases. I don't know did I touch on the financing. Let's say if you wanted financing, let's say you want to do 75%. You can see that how much that affects the internal rate of return, and that's just saying you have to put less in. You have a less of a cash requirement, and you're still getting those cash flows from the investment. So it makes sense. You're paying interest to the bank in return for not having to use so much capital. And when you sell the building, and clear off the balance of the loan, you know, it makes financial sense. And now that's going to be all based on your rent revenue, which, let me see, where can you adjust that at? Vacancy, here. Your starting monthly rent. So right now I've got it at 1.5% of the property building cost. That could be 1%, and obviously that's going to lower, look at that, lower the project IRR down to 15%. So this is going to be really sensitive. Let's say we put it at 1.25%, and up to 25% project internal rate of return. So this is going to affect, and this is the cash flows, this is the revenue, so it should be a strong driver of what's going on with the cash flow. But all these other little assumptions and stuff, it's important to try to get an idea of and plan of action, so they don't affect the cash flow as much as say rent, but it's still important so you can get as close to as possible to what you want to do and what you expect to happen, so you're prepared. So put this back down to 50%. And then, for example, let's say the investor only wants to put in, it's a $6.7 million deal. Let's say they only want to do $500,000. That's going to force financing of $3.4 million, and then you're going to need equity from investors of $2.9 to cover this projected, initial cash outlay that you need. And then you got coming back to you, even though you're only putting in $500,000, if you can get this project internal rate of return up, let's get it up by simply lowering the time it takes to sell. And actually that didn't change it as much because of the way the financing and everything is structured. Let's go up. That's not affecting it at all. It's actually not having that much of an effect at the moment. I know this will. Let's put this down to 6%. There, it's already up to 20. I'm just trying to get up to 35%. Let's just raise our cash flows up to, oh, that's rehab. Here we go. Let's raise this up to 1.5. There we go. 37%. So now the sponsor is only put in 500,000, and if they can get that IRR, 4-year deal, sell it at that cap rate, 6%. 6%. Look at that. You're getting a net cash flow of 900,000 profit. Total cash flow you're getting back into your bank is 1.4 before tax. And then with the hurdle, look at that. Goes up to 3 million net cash flow pre-tax. So you're only putting in 500, you're making $3 million profit in 4 years if you can do it and sell at that building cost and follow the rest of the projections. And you can see how the sponsor gets rewarded based on, you know, doing good on the project. Okay, now this model was I mean, it's taken a year of experience just learning how to build real estate models to get to the point, and then it still took me a while to get this thing so it does everything I wanted it to be able to do and have the ease of the inputs, which you can change anything on this page here and it's going to affect everything else. You don't need to go to any other page if you don't want to. Everything is controlled right here. And then here's your main, you know, what you're going to want to be looking at. So I don't think I've got anything else to really explain. If you want to purchase this model, I am selling it for $299.99. I feel like that's a very fair price, and with that sale I can help you understand it better, maybe implement it for your unique situation. I did try to leave a lot of expense rows because it's harder to I can't add them, but it's harder to add it rather than it's easy to just not have an expense row. So I tried to put a lot in there. So it's ready to plug numbers in and go. If you do want to purchase it, I'll have a link in the description box below that will allow you to click through to my website and make the purchase. And I do accept credit cards or debit cards. Okay. I hope you have a great rest of your Sunday. I'm going to try to play around with some of the formatting and coloring of this to make it look even cooler than it does now, but I'm really happy I got all the numbers to where they need to be. It's all accurate. It's, you know, perfection, and it took a lot of experience and intense work to get this thing to where it is right now. So I really hope, you know, you guys can end up finding it useful, and I meet some interesting people as a result of this as well. Alright, I am off for now. See you on the next model.